It is 11:47 p.m. Eastern Time on Thursday, March 12th, 2026, and this is Active John. I need you to stop scrolling for just a second and understand exactly what is happening on the other side of the planet right now. While you were watching your portfolio bleed today, while you were reading those panic headlines about the latest CPI report, and the $1.8 trillion private credit stress surrounding firms like PIMCO, while you were maybe even debating whether to sell your silver stack because the spot price crashed all the way down to around $84.46, something important happened. The sun set on Wall Street. The American trading session closed for the day. The algorithms went quiet. The credit funds stopped their forced liquidations. And right now, at this exact moment, the sun is rising in Shanghai. The trading floors in Hong Kong are lighting up. The vaults in Singapore are opening their heavy doors, and the wealthiest institutions in the Eastern Hemisphere are looking at the exact same $84 silver price that terrified so many investors today. But they are not panicking. They are not selling. In fact, many of them see this as one of the largest physical discount opportunities of the year. While you sleep tonight, a massive shift in global capital is beginning to unfold. Think about the psychology at play here. In the West, we often react with emotion to short-term price movements. A sharp drop triggers fear, and that fear leads to selling, which then causes more fear and more selling. It's a vicious cycle, fueled by high-frequency trading and media headlines designed to grab your attention. Today was a textbook example of that fear taking over. But on the other side of the world, a different mindset is taking hold. In many Eastern cultures, a lower price isn't seen as a crisis. It's seen as an invitation. It's a sale on a real, tangible asset. They operate on a much longer time horizon. They aren't thinking about next week's options expiration. They're thinking about the next decade, the next generation. They see a fundamental asset, silver, which has been money for thousands of years, being offered at a temporary discount because of a credit crunch happening thousands of miles away. So, while one part of the world is desperately trying to raise cash by selling whatever they can, including their precious metals, another part of the world is eagerly waiting with cash in hand, ready to buy those same assets at a bargain. This isn't just about trading. It's a fundamental transfer of wealth from weak hands to strong hands, from short-term speculators to long-term accumulators. So, what does this mean for you, sitting here watching this? It means you have a choice to make. You can follow the panic you saw in the markets today, or you can try to understand the perspective of those who are seeing this as a strategic opportunity. Ask yourself, have the fundamentals of silver changed? Is it suddenly less useful in solar panels, electric vehicles, and medical devices? Has its history as a store of value been erased overnight? Of course not. The only thing that changed today was its paper price, driven by fear and leverage in the Western financial system. The physical metal is the same as it was yesterday. The major financial institutions in the East understand this perfectly. They know that these moments of extreme fear in one market create generational buying opportunities in another. They are not chasing algorithms. They are accumulating real assets. They're playing chess while much of the West is playing checkers, reacting to every little move without seeing the bigger picture. Over the next few hours, before New York even wakes up, a significant amount of physical silver is going to be spoken for. It will move from vaults in London and New York to vaults in Singapore, Hong Kong, and Shanghai. This happens quietly, away from the flashing lights of the financial news networks. It's a silent tide of metal flowing from west to east. And when the sun rises over America tomorrow morning, the landscape might look very different. The supply that was available yesterday might not be there. The price that caused so much panic might suddenly find a very strong floor. This is the reality of a global 24-hour market. What looks like a disaster in one time zone is viewed as a fire sale in another. The key is to detach from the immediate emotional reaction and look at the global flow of capital. Who is selling and why? And more importantly, who is buying and why? The sellers today were forced, they were scared. The buyers tonight are strategic, they are patient. My message to you is simple. Don't let the short-term noise of the market distract you from the long-term fundamentals. Before you make any decisions based on fear, take a deep breath and consider what is happening globally. Understand that while our markets sleep, a whole other world of capital is waking up with a very different perspective. They aren't just buying a number on a screen, they're securing a physical asset for the future. This isn't just another trading day. It's a profound moment in the ongoing global economic shift. Think about which side of this historic transfer you want to be on. What I'm about to share isn't just a theory or some market hype. Think of this as a field report, a boots-on-the-ground analysis based entirely on publicly available data and recent market activity that you can check for yourself. First, a quick but important reminder. This is not financial advice. My goal is to present information and connect the dots. You should always do your own research, verify the numbers, and make decisions that are right for you. Now, with that said, let's get into the data. I want you to look at a few specific things. Start with the premiums on the Shanghai Gold Exchange. Notice the spread compared to London or New York. Then, pull up China's customs trade data, see the import and export figures for key metals, and finally, review the official reserve reports from the People's Bank of China. When you put these pieces together, a picture starts to form. A picture that shows a significant, sustained movement of physical metal. And it begs the question, why isn't this getting more attention? Why is this information rarely making it into the mainstream financial discussion, especially at a time when many investors are being told to rotate back into risk assets like stocks? This channel, Active John, exists for one reason: to break down these major macroeconomic shifts that often go unnoticed by the average retail investor. We peel back the layers so you can see what's really driving the markets beyond the daily headlines. The narrative we're often fed is that everything is returning to normal, that central banks have everything under control. But the flow of physical assets tells a different story. Think about it from a strategic perspective. If a country or a major institution wanted to strengthen its financial position quietly, without causing a major market panic, how would they do it? They wouldn't announce it on the front page of the Wall Street Journal. They would accumulate assets steadily, quietly, using the existing market infrastructure. The data from the Shanghai Exchange, the customs reports, these are the footprints left behind. We're seeing a divergence. On one hand, you have the paper markets, the futures, the ETFs, where prices can be managed and narratives can be shaped. On the other hand, you have the physical market, where real bars of gold and silver are being moved and stored. And right now, the demand in the physical market, particularly in the East, appears to be incredibly strong and persistent. This isn't about being a pessimist or an optimist. It's about being a realist. It's about looking at the actions, not just the words. When you see such a large-scale accumulation of a timeless store of value, it suggests a long-term strategic play is underway. It suggests a preparation for a different kind of financial environment. So what does this mean for you, the individual investor? It means you need to be aware that there are powerful undercurrents moving beneath the surface of the market. The story you see on TV might not be the whole story. The real value, the real security, might be shifting hands right under our noses. This is a quiet revolution in the global monetary system, and it's happening 1 ton of gold at a time. Now, I really want to hear from you. What are your thoughts on this? Have you been tracking this data? What conclusions are you drawing from the massive physical offtake in the East? Be honest in the comments below. Your insights are incredibly valuable for this entire community. As we all try to navigate these complex times together, this is how we learn from each other and build a more complete picture. Did you panic sell today, or are you still holding on? Did you fall for what we call the paper panic? Or are you a savvy investor, watching the global market structure and waiting to see what happens as the Asian markets open their doors? Understanding the crucial difference between the paper price of precious metals and the actual physical demand is one of the most important lessons you can learn in this space. It's a game changer. Think about it. Every single time Wall Street goes through a major liquidity-driven sell-off, history shows us that physical buyers almost always step in to take advantage of the lower prices. It's like a predictable pattern. We saw a classic example of this during the wild volatility of 2020. Remember that? Paper prices for metals took a nosedive, dropping rapidly. But what happened in the real world? The premiums on physical coins and bars surged through the roof. Why? Because the supply was incredibly tight, and everyone wanted to get their hands on the real thing. This disconnect between paper and physical is exactly why today's market action is so fascinating and deserves our full attention. So let's get into the weeds and break down what actually happened today, step by step. Earlier this morning, the U.S. Bureau of Labor Statistics dropped the February CPI report, and it definitely stirred the pot. The headline inflation number came in just a little bit hotter than what everyone was expecting. Not a huge surprise, but enough to make the markets nervous. The core inflation figure printed at around 3.1% year over year, which was also above the consensus estimate. And let me tell you, the bond market reacted instantly. Treasury yields spiked upwards, and that was the trigger. All across the global markets, the algorithms, the automated trading bots, kicked into high gear and started their risk reduction strategies. What does that look like? It's a domino effect. Stocks started dropping. Commodities took a hit. And precious metals, unfortunately, were caught right in the crossfire of these automated trading systems. It wasn't about fundamentals at that moment. It was about algorithms executing pre-programmed sell orders to reduce risk across the board. Silver, for example, made a really sharp move lower during the session. It fell from around $91 earlier in the day all the way down to near $84 by the afternoon. That's a pretty dramatic move for a single day. But here's the key takeaway. A move like that isn't necessarily tied to the long-term fundamentals of silver or the broader precious metals market. It was a reaction to a data point, amplified by high-frequency trading. And this is where it gets really interesting. Because at the exact same time all of this chaos was happening in New York, another major market was just waking up and preparing to open on the other side of the world, Shanghai. the physical market, the demand center. What happens there often tells a very different story from the paper markets in the West. It's the difference between a fleeting sentiment and real tangible demand. That's why we always say to watch what the big players do, not just what the screen prices say. Ever wondered why the gold market in the East and West seems to play by different rules? Well, tonight we're diving deep into a fascinating dynamic that could be shaking up the entire precious metals landscape. Let's start with a key difference: how gold is traded. In places like New York or London, the market is dominated by what we call paper gold, futures contracts. It's fast, it's liquid, but a lot of it never results in actual physical gold changing hands. Now, contrast that with the Shanghai Gold Exchange. Their system is built with a much stronger emphasis on physical settlement. This isn't just a minor detail, it's a game changer. It means that when prices are set in Shanghai, they are much more closely tied to the real supply and demand for physical bars of gold. This creates a fascinating push and pull. Imagine a scenario where prices drop sharply on the New York Exchange. For a paper trader, that might just be a number on a screen. But for a physical buyer in Asia, a lower price is a golden opportunity, literally. They see value, and they step in to buy actual metal. This physical demand can act as a powerful floor, supporting prices when the paper markets get volatile. It's a classic battle between paper sentiment and physical reality, and often the physical market has the final say. We're seeing this play out right now, and it's making things very interesting. So, what's fueling this physical demand, especially from China? A huge piece of the puzzle is their massive trade surplus. Just recently, China reported another large surplus, which means a tremendous amount of foreign currency, mostly US dollars, is flowing into the country from all the goods they export. For decades, a standard playbook was to recycle these dollars back into US Treasury bonds. It was considered the safe default option. But that playbook is changing. We're witnessing a major strategic shift. Instead of putting all its eggs in the Treasury basket, China has been actively diversifying its reserves. They're moving capital into a variety of other assets. And guess what's high on their shopping list? Gold. This isn't just speculation. The data backs it up. The people. The Bank of China has been consistently reporting increases in its official gold reserves month after month, year after year. This isn't a short-term trade. It's a long-term strategic accumulation. They are systematically strengthening their financial foundation with hard assets. This steady official buying adds a whole new layer of support to the global gold market. It's not just individual investors. It is one of the world's largest economies making a clear statement about the value of gold. But the story doesn't end with gold. Let's talk about its sister metal, silver. While gold is the ultimate monetary asset, silver is a unique hybrid. It has a monetary history, but it's also a critical industrial metal. And its industrial demand is set to explode. Think about the biggest technological trends shaping our future: the green energy transition and the digital revolution. Silver is essential to both. First, solar panels. Every single solar panel manufactured needs silver paste to conduct electricity. As the world races to build out renewable energy capacity, the demand for silver from the solar industry is soaring. Then there are electric vehicles. EVs contain significantly more silver than traditional internal combustion engine cars, used in everything from battery connections to electronic components. As the auto industry electrifies, that's another massive source of new demand. And finally, let's not forget the backbone of our modern world: semiconductors. Every computer, every smartphone, every smart device relies on these tiny chips, and silver's unique conductive properties make it a vital ingredient in their manufacturing. Many analysts believe this trifecta of industrial demand, solar, EVs, and semiconductors, is creating a structural demand story for silver that will continue for years to come. So while gold holds its own as a store of value, silver's industrial role adds a completely different and very compelling dimension to its investment case. Thanks for watching, everyone. If you found this breakdown helpful, be sure to hit that like button and subscribe for more insights into the global markets. See you next time.